Hello, we're continuing on with the pension lecture note and example 3, and now we're in 3B, video B. Last time we discussed the liability gain or loss and corridor. And I'm going to add a more extensive description that I'll post for the corridor with a step-by-step and then going back over the formula. So you could take a look at that. But what I wanted to do in this video primarily was circle back and take a bigger picture at the worksheet. In the worksheet, we have essentially over here in this memo record, this is the actuary's report. And again, the actuary is a person who knows a lot about statistics and predicts or values risk, I should say, for like car insurance, life insurance, and here pensions, which are in a sense insurance. Okay, so we have the PBO and the plan assets, which come from the actuary, and over here, these are all accounts. It's the journal entry, but these are all accounts in the ledger, and these are all the accounts you'll ever see in pension accounting. Pension expense, cash, other comprehensive income, prior service costs, other comprehensive income gain loss, which relates to asset gain losses and liability gain losses, and then the pension asset or liability balance. And we say asset or liability because it can be that, like in this case where the PBO is greater, you end up with a liability. If the PBO is less than the plan assets, then you'll end up with a pension asset. But you should be able to say that this in particular is a pension liability. So this row is a balance row. We have the OCI prior service cost, which is created when there's a change in the pension plan that gives benefit for prior work. So, for example, let's say the old pension plan said you get 70% of the average of your last 5 years' salary, and management decides to boost it to 80%, and they're going to give you credit for all the prior years of service prior to today. What the FASB allows is that doesn't have to go directly to service cost and through expense. It goes through other comprehensive income prior service cost and then gets amortized to expense year by year. So this year, for example, 17,000 of it is going to pension expense right here. All right, so I like to think of OCI prior service cost as an inventory of future pension expense. All we're doing is taking this debit from stockholders' equity OCI prior service cost to a debit through pension expense and retained earnings. So it's just moving from one stockholders' equity account to another, from accumulated other comprehensive income to retained earnings. And it goes through the income statement. Okay, so that is a normal debit balance. The OCI gain loss can have a debit or credit balance, because you can have a gain balance like this, which is a credit as a gain, excuse me, and if it's a debit balance, it's accumulated loss. So this is an accumulated gain, and you should be able to identify accumulated gains and losses. All right. Okay, so once again, we went through 1, 2, 3, 4, 5A and 5B component of pension expense, and this is liability gain or loss is not a component of pension expense. All right, but quarter amortization is. So you add all these up and you get your pension expense. So you could do this, and we did do this in example 1 and 2 without a pension worksheet. We just added these components up. Okay, so there's your pension expense. Your cash is always going to be a credit. This is going to, and it's really clear to see on the worksheet, this is going to the plan assets. So the company doesn't pay employees directly. They have to pay the pension plan. All right. Let's see. And then we have our prior service cost amortization as part of our journal entry. So every column, debit, credit, except not the balance column, is being totaled. Okay. And then this is minus the sum. This is your plug number. It's minus the sum of the other components, or excuse me, the other journal entry items. So you take 76,053 minus 57,000 minus 17,000 minus 13,061. Sum that up and take the negative of that, and it's 11,008. Now, the way this worksheet can help you find some errors, not all, is you know what the answer is. It's kind of like a balance sheet where you know assets equal liabilities plus stockholders' equity. And if you don't have the right balance, you know the balance sheet's wrong. If you have the right balance, sometimes you have two offsetting errors. But regardless, this is one way to capture an error. You know that the net funded status is 819,392 minus 706,480. So you can calculate the 112,912 and the 123,920. You can calculate that before you even do your journal entry. So you know what your answer is going to be. I would not plug that cell, however, because what you're trying to do is calculate 11,008 two different ways. So you have, I'll do a journal entry style first. You have the pension asset / liability started with a 123,920 credit, ended with a 112,912 credit. So then you could plug 11,008. Okay. And the other way to do it, just, well, the T account is math, but you ended with a minus 112,912, and you minus a minus 123,920, and that'll equal also 11,008. Okay, so you can calculate what the answer should have been, and if it's not, you'll go and look for errors. The most common error is on the worksheet, you have to have a debit, credit, debit, credit, debit, credit, credit, debit, debit, credit, credit, debit, credit, debit, credit, debit, credit, debit. Okay, so the most common mistake is to forget to put an offsetting credit or debit. The next common mistake, so let me just from experience tell you, error checking. 1, debit credit match, pairs or check for pairs. The second one is pension expense total. And then it kind of gets hard, well, it really gets harder after that, but other totals. Okay. So the first thing I would do if you have an error is make sure debit, credit, debit, credit, debit, credit, debit, credit. Then the next thing I would do is total this, because that seems to be most frequently, because it has the most numbers. Fat fingers error, or somebody forgets to put in a minus, something like that. And then after that, all you could do is check all the sums, double check. Okay. So let's go back up here. See if we answered this. So we had our pension expense, our amortization of prior service costs, our sum. So for OCI gain loss, you had an asset gain. So this is a credit gain. Liability, this is an asset. Oops, I mentioned this last video, but I'll mention it again. This is a liability gain. So it's a credit, increase of stockholders' equity, that's a gain. And this is not a loss, this is just amortization, quarter amortization, I guess it's right there, but say it again, once again, remember this is a debit because the beginning balance is a credit, amortization is a reduction. So you total these three up. What happened to my pen? Oh, there we go. And you get that 13061. So this up here is, oops. This is a balance up here. So, we don't add in the 121. We do use 121 adding the 13061 to get the ending balance of the OCI gain loss, and we take the 83,000 less the amortization to get the ending balance of the OCI prior service costs. All right. So I guess one last thing to notice is this does come up. Notice the projected benefit obligation is increased by service cost and the interest cost. It can be increased. It's by a liability gain or loss. It's decreased. By a liability gain. So this is a gain decreases, but a loss would increase. It's increasing your liability, right? So if life expectancy went up, then the projected benefit obligation would go up, and you would add a debit to OCI gain loss. And the benefits paid, they come out of plan assets, but they offset your obligation dollar for dollar. So this actually payment to retirees doesn't affect our pension accounting, actually. They net out. But I do want to point out these components. So here's a return, here's a funding, and here's benefit paid. Because what happens on some CPA questions and questions that may end up on my test is they'll tell you the beginning and ending balance of the PBO or the plan assets, and they'll give you everything except one, and you'll have to use algebra to solve for the missing component. So they'll tell you plan assets was 613,480 and ending plan assets was 706,480. Benefits paid were 25,000. The contribution was 57,000. What was the return? And you'll just use 613,480 plus this plus X plus 57,000 minus 25,000 equals that, and you solve for X. Okay, so it's good to know the components of the PBO and the plan assets. And here's your funding payment and your plug. So if you're doing this journal entry style, you could calculate your pension expense, you could put in your amortization, you could calculate your OCI gain loss on the side, and your cash. Sometimes you will have a worksheet, sometimes you will not. All right. So you have to be able to do it either way for my exam and for the CPA exam. All right, so this was for 2009, and C is asking for 2010. So why is it doing that? I'm just trying to emphasize that the quarter amortization uses the beginning balance. You might be tempted to look ahead. For example, in this one, we amortized, yet OCI gain and loss was larger than it was at the beginning of the year. GAAP doesn't care. The FASB did not care. They just said use the beginning balance, period. So for the next year, we know that our beginning balance is going to be 134,061, and we can stick with the average remaining service life of active employees. And we also have, the beginning balance of the PBO, 819,392. So the amount subject to quarter amortization, so the amount above, this is greater than the corridor by 52,112, and then you divide it by 10, and next year you can predict that you'll have 5,212 of quarter amortization. Okay, but once again, just doing this item C to emphasize, don't look ahead. Just use the beginning balance of the OCI gain loss when doing corridor. Okay. It would make sense to look ahead and make sure it was actually the total balance was reduced by the end of the year. But the first thing you do as a CPA is follow GAAP. Always the first thing. Okay. Yes, that's it for the pension exercise number 3, and we'll look ahead to number 4.